403Bs, which are now subject to ERISA requirements. So a lot of those are now subject to audit. Profit sharing, some defined benefit pension plans, which are quickly becoming a thing of the past, health and welfare plans. We are also members of the Employee Benefit Plan Audit Quality Control Center. And I will let Jennifer Arminger introduce herself.
Thanks, Jackie. So I am also an audit partner in our nonprofit audit division here at Gelman, Rosenberg Freedman. And I have helped Jackie co-manage our employee benefit plan practice since I joined Gelman in 2008.
Okay, very good. Thank you, Jennifer. So on our agenda today, we're going to cover three main topic areas: requirements for an audit, the 2015 and 2016 changes for presentation of the plan information, proposed future changes, and that will cover changes to the 5500 as well. So let's talk about the requirements for an audit. And actually, before we get into the information, I want to start off with a polling question. Are you currently subject to a retirement plan audit? So if you can take a moment to respond to that. If you know, A, yes, B, no, C, I don't know. That would be great.
Yeah, and that'll pop up on the side, so take your time answering that. We'll come back to the answer after everyone has the chance to submit.
Okay, perfect. So when do you need to have an audit of your plan? We get this question a lot, and the answer is not as cut and dry as it may seem. First of all, the basic determination of whether your plan is subject to audit is if your plan is subject to Title I of ERISA. Okay, ERISA plans are subject to audits. One way of finding out if you have an ERISA plan is looking at your adoption agreement. Either your original plan document, if you have an individually drafted plan that was drafted by an attorney just for your plan, or the other option is that you adopted a plan, a prototype, or a volume submitter, basically a template, if you will, from a custodian or trustee. With that, you will have signed an adoption agreement where you checked off the different provisions you wanted to elect for your plan, and there is a box, or there should be a box that indicates whether your plan is ERISA or not. ERISA is essentially the law that covers benefit plans. It is administered and carried out by the IRS and the DOL. And plans that fall under ERISA are subject to audit requirements and various other compliance requirements. So the general rule is that when your plan reaches 100 participants or more, at the beginning of the plan year is when you are subject to audit. And a couple of key things here. Beginning of the plan year. So for your 2016 plan year end, you'd actually go back to January 1st of 2016, look at the number of participants to determine if you are at that 100 threshold or have exceeded it. Now, the other key thing, participant. So let's go look at the definition of a participant, because immediately a lot of employers think, okay, number of employees. I have 79 employees, so my plan can't possibly be subject to audit. However, the definition of participant is a little broader than that. And actually, it includes active employees who are participating in the plan, but it also includes terminated employees who still have account balances remaining in the plan. So if you have a plan that's fairly old and you've had employees that have terminated several years ago who may still have funds in the plan, they are considered participants under that definition. Also, active employees who are eligible, that means they meet all of the eligibility requirements, but they've elected not to participate. So if you have someone who waives their right to participate after they become eligible, you still must count them as a participant. So that's where we've seen a lot of clients come in who kind of, get into a murky area there, because we've also seen plans that have a population of employees who many of them don't tend to participate. They don't have a high plan balance. They don't have a significant amount of assets in their plan. So it's fairly small in terms of the size of the plan, but they have many, many employees who are electing not to participate. Unfortunately, that still could subject you to an audit if that number exceeds 100. So with that, let's say that you have a plan that usually fluctuates somewhere between 80 and 120 employees, roughly. There is this rule out there called the 80-120 rule, which you may or may not have heard of it. And that could potentially be an exemption for you for an audit requirement. So what happens is, if your plan goes between 80 and 120 employees over various plan cycles, various years, you can elect to file. If you filed as a small plan in the prior year, meaning you were under 100 participants, you haven't yet exceeded 120, you can still file as a small plan. So a small plan is under 100 participants. They file the short form 5500. An audit is not required of your plan. You do not need to attach an audit report. The large plan, which is 100 participants or more, files the full 5500 form with a Schedule H, which is all the financial information and detail of the plan, and you are required to have an audit and attach that audit report to the 5500 when it is filed. So just to go over this again as an example, you have a look-back year, the year prior. So if you had, let's say, 85 participants in 2015, and in 2016 you had 101, you can look back and say, well, in 2015 I filed as a small plan. I haven't gone over 120 yet, but I am over the 100, so I'm right in that range between 100 and 120. Last year, I was able to file the short form 5500 as a small plan because I only had 85 participants. So I'm going to elect to file again as a small plan and not have the audit, which you can do. So as long as you don't exceed that 120, you can always go back to the prior year, and if you filed as a small plan in that year and didn't have an audit, you can do the same. And now the question comes up, well, what happens if I exceed the 120? At what point do I have to be where I can not have an audit again? What's that magic threshold? So what happens there is, if you exceed 120, you are then subject to audit. Okay, assuming, let's say in the year prior you were over 120 as well. Okay, you now reach a point where you become a large plan. You have to file as a large plan. You have to have an audit. So what you then need to do is go back below 100. You can't go down to 101 or 110. Once you exceed that 120, you're officially considered a large plan and have to be audited. And in order to forego that audit requirement, you will then have to go back below 100 participants to be able to be considered a small plan again. So again, we'll take questions at the end if there's more questions on that. But I do want to give out our first key word that you will need for the survey, and that word is retirement. So the first key word for the survey you will need if you're obtaining CPE is retirement. So there are certain situations in which plans are exempt from the audit requirement. There are governmental plans. Governmental plans, those plans established by a government agency of the U.S. are not subject to audit. Church plans are not subject to audit. And certain safe harbor plans. Safe harbor plan is funded solely through salary reduction agreements, and they are not maintained, meaning the employer is not responsible for maintaining the plan. And the best example I can think of that are some of the 403B plans that are still set up as just solely salary reduction agreements. there are insurance contracts purchased for the employee. The employee actually owns those contracts, so the contract is directly with the employee. They're only funded through salary reductions. The employer contributes nothing. All the employer does that they are allowed to do is essentially withhold money from your paycheck and remit that on your behalf to your custodian and keep the records for that. And there is no other involvement. So if it meets those criteria and it's the right type of insurance contract or investment, then it could be considered a safe harbor plan and therefore not subject to audit. So with that, I'm going to let Jennifer go into understanding the changes that are coming up, the 2015 and 2016 changes that are on the horizon or actually have already occurred for employee benefit plans.
Great, thanks, Jackie. So before we jump into that, I just wanted to kind of touch base on the results of the first polling question, which was actually really interesting. We have a pretty evenly distributed results of 25, 27, and 20% respectively of whether plans are yes subject to an audit, no, or some of you just don't know, and so we're certainly hoping that you take away that information from this CPE. So in 2015, there were two new accounting standards that were released that roll out and go into effect over the next couple of years. And the first one we just want to kind of take a dive into is ASU 2015-12. And this standard is applicable to our defined benefit plans, our defined contribution plans, so your 401As, your 401Ks, your 403Bs, as well as your health and welfare benefit plan. And it really aims to simplify a lot of the additional reporting requirements within plan financial statements. So what you'll see when we kind of walk through some of the more significant changes that are rolled out under this new standard, we see a lot of simplification and actually removing requirements on reporting, which is certainly a great thing for us auditors and the users of your plan financials. So the very first item is related to those of you that have these fully benefit responsive investment contracts. So they are relatively common within plan investment portfolios. Items such as guaranteed GICs, guaranteed investment contracts. But what the relevant transaction measure is the contract value. So employees transact at the contract value. But what is currently the requirement is that for financial statement reporting purposes, you would need to do an assessment of fair value. So taking that contract value and for reporting purposes, kind of estimating what that fair value would be, and that's how you would report within your plan financials. Well, they finally realized that this just was not useful information and that all transactions are happening at this contract value, so they have removed that requirement to disclose what it would be at fair value, and you are only now required to report contract value. The next item was the removal of a footnote disclosure that currently required you and us to disclose which individual investment funds were 5% or more of the net assets available. So if you had an investment in Vanguard bond funds and that total exceeded 5% of what was available for net assets at the end of plan year, there was a requirement to disclose that. That has now been removed. And the last two really consolidate information that was previously disaggregated. The first being the appreciation or depreciation of value of your investments. You would currently have to break that out by type of investment. So whether it be mutual funds or pooled separate accounts or collective trusts, the appreciation and depreciation would have to be broken out, and they have eliminated that requirement, and you now are able to just report that in one consolidated amount. And the final kind of more significant change under the new standard is the requirement to disaggregate the investments by nature, characteristics, or risks. And so while maybe you have seen that investments in mutual funds were broken down by categories such as large cap funds or growth funds or value funds, that is no longer a requirement, and you are able to just report the investments in total by type of investment. So this accounting standard is effective for fiscal years beginning after December 15, 2015. So majority of plans are on a calendar year. So what this means is really that it is applicable for your 2016 audit. It is required to be implemented for the 2016 year. And for some, especially with our clients, early adoption was permitted, and so the simplification of reporting, we went ahead and early adopted several organizations last year. So the next standard that we're going to review, while the previous accounting standard was only applicable to retirement plans, this is actually applicable to both your retirement plan as well as your financial statements. And so this may affect your organization and the presentation if you hold investments, if you have an investment portfolio, and specifically if you have investments that are calculated at net asset value. So this standard removes the requirement to categorize those investments that are using net asset value as an expedient for fair value. You are no longer required to include them within the fair value hierarchy table. And so, that's the table where you have your investments and they're categorized as a level 1, 2, or 3. Based on the level of inputs it took to arrive at that fair value amount. And really what this is saying is that, when we're calculating net asset value and we're using that as this concept of it's a practical expedient for fair value, it actually isn't using any sort of inputs. And so therefore it really doesn't belong in that fair value table. So you're still going to go ahead and disclose the description of the investment and how it's calculated and the amounts to reconcile back to your total investments per your balance sheet, but you will not include it anymore within one of those levels in that table. So this standard is actually not effective or not required to be implemented for plan years beginning after 2016. So 2017 would be the required implementation date. But again, early adoption is permitted, so certainly something you as plan management, plan sponsors can discuss with your auditors or outside accountants. So we do have an example of what the presentation would look like for that last standard, but before we get to that, let's take another quick polling question. And we're just curious if you are aware if these new standards apply to your plan, and really it would also apply to your financial statements for the last item we just covered. So we'll come back to those results, and we'll just quickly take a look at what the presentation of that last standard might look like in your updated plan financials as well as your regular financial statements. And so here we have that table with the different level of inputs. Mutual funds, registered investment companies at level 1, they are actively traded on the markets. Our inputs to get to that value is very few, whereas the unallocated insurance contracts have that level 3 valuation with more significant inputs. And then here's where the difference is we have the subtotal of the total investments that are being measured at fair value. And then we have now removed those investment vehicles, in this case pooled separate accounts, that are calculated at net asset value and are just including in the total line to get back to the total investments. But again, not including as part of the fair value hierarchy. And so again, as for the polling question, we got a pretty consistent response between 18, 20, and 18% of you all saying that yes, these standards apply to me, no they don't, or just that I'm not sure. So now's a good time to pause and just give our next keyword for CPE. So if you are collecting CPE, the second word would be plan. So our next topic that we really wanted to cover today was related to the proposed future changes in the industry. So we wanted to take the opportunity to discuss what's coming down the line for you all, for retirement plans, and for the industry in general. So the first big change, or at least the big change that we're going to discuss that will be coming down the line is an overhaul of the Form 5500. And Jackie started talking about the 5500 earlier. That is the tax form that's required to be filed if you have a retirement plan. And so, I mean, that's in most cases, and of course we're generalizing here, and there are a few exceptions. But even regardless if you have an audit or not, there is a version of this form that you would file. So whether it be the short form 5500, the condensed version, or if you are required to have the audit, you would file the full 5500, the large form with Schedule 8 and your audit report. And really this form is important because it provides a significant amount of data on the state of retirement plan benefits and the composition of investment portfolios in the U.S. To those regulatory agencies. So this is where the IRS and the DOL collect the majority of their information about the state of benefits out there. And so, it's very important that we keep up with the changes in the industry and that we periodically review and modernize these types of forms so that it can reflect what's happening in our everyday world. And so this is exactly what is being proposed for the 5500. I think the last time there was a change, it was over a decade ago, and so it's certainly time to take a look. These changes that we're going to go through on the next slide are just proposed at this point, and they are open to the public for comment. And right now, the implementation date would not be until calendar year 2019. So a couple of years to get ready, but time goes quickly, and so I'm sure it'll be here before we know it. So we're going to review some of the more significant proposed changes, and for each of these items, there are a number of subsets that roll up into the overarching concept or theme that we're going to go over. But we've highlighted 6 pretty significant changes, or these 6 that will see improve and modernize the Form 5500 the most. The first, that the DOL will aim to improve compliance under ERISA and the Internal Revenue Code through a new series of questions regarding the plan operations, the service provider relationships, and the financial management of the plan. And so really what this means is that there will be a series of new questions that really speak to the internal controls in your organization and how those are set up, your processes, and what they would consider best practices with the industry and whether or not your organization has implemented such items. The next big change would be to improve the certification requirements for limited scope audits. And our limited scope audits, at least for our client base, obviously the most common, but it's going to ask more detail on what's covered under that certification. And more so whether management has reviewed the appropriateness of it. And this is really getting to whether we can rely on the certification and the information that is being provided by our custodians and trustees, and that there's not, a significant risk that there would be an issue in them administering and holding your plan assets. The next item would be to modernize the financial statement section and the investment information. So here they're talking about asking for a lot more detail on the investment makeup, and especially on those hard-to-value investments. And so we all know that the industry is ever-changing in the types of investment vehicles that are being offered out there. And so this form, is aiming to improve how we capture the new types of investments that our plans are investing in, and this actually goes for both the short form and the full form 5500. So you'll see an increased level of detail requested on both forms. The next item is updating the reporting requirements for service provider fees and expense information. And really this is just going to aim to ask and see how you can better track the fees that are disclosed related to your investments and to the administration of the plan. The next item that is proposed is to enhance the accessibility and usability of the data on the forms. And so what this means is that they're going to try and convert a lot more of the fields on the Form 5500 into an actual data field. And so that when they receive these 5500s, they can take those fields, those data fields, and it can be used for data mining and additional analysis. And the last change in reporting requirements is related to the group health plans. And so this is probably the most significant that we will see as far as the form catching up with the industry. The current form doesn't ask very many questions, if anything, about group health plans that are subject to ERISA. But the new form would actually include an entirely new schedule that will be added to report on the participants and the type of coverage they're getting under that group health plan. And so ultimately these changes are aimed to and will satisfy the reporting requirements under the ACA. All right, so we're going to pause and just quickly ask if you all prepare your 5500 in-house. And now's a good time to give our final keyword for the CPE before we touch on our last topic and then spend some time answering our questions. But the final keyword is audit. Great. So the last item that we want to take a look at is a change. It's the new DOL Fiduciary Rule. And so this ruling was actually released in April of last year. And while it's very much geared more towards the industry providers, so the retirement plan industry providers, we anticipate that the plan sponsors will see some potential impacts on their reporting by these providers, as well as possible increase in fees. So the DOL, after I think it's been over 40 years, has finally changed the definition of who is considered a fiduciary under ERISA. And really the change has been long anticipated because there has been a significant shift in what retirement plans look like over the past 40 years. And Jackie had mentioned it before. It's moved from these traditional defined benefit or defined pension plans, those pensions that just don't exist anymore, to the more defined contribution plans and IRAs. So it was important that this old ruling was changed to catch up with the shift in types of plans that are being offered by employers in the industry. So the new ruling was actually supposed to roll out this month, April 2017, but has been pushed back to June of 2017, just with the change in administration. So we will actually see if that date stands, June, or if it will be pushed back again. But this is fully implemented and released, so we know that it will ultimately roll out. The question being just when. So the old definition of a fiduciary was really a 5-part test, and you would need to meet all 5 of these items to be considered a fiduciary. And remember, a fiduciary implies this level of trust and good faith in a relationship, which is typically accompanied by one party holding money on behalf of another party. So they are held to a higher standard, and so we've kind of shifted that definition of what a fiduciary is. And so under the new ruling, the definition demands that advisors act in the best interests of their clients and put their client interests before their own. And so it has a lot of increased requirements around disclosing potential conflicts of interest, which is important for you all, and one thing that the plan sponsor should be aware of when transacting and deciding which investments and funds to offer within your plan. What are those conflicts of interest? And so what you'll be receiving now is an increased reporting on the fees and the commissions that your investment advisor or your custodian or trustee will be receiving, disclosed in dollar form if you invest in certain funds. And so the most significant change being that that 5-part test is eliminated, and the new definition now expands to any professional making a recommendation or a solicitation, whereas under the old rule or the old definition, it really, they could get around that because they weren't offering ongoing advice. It was just a one-time solicitation or outreach, and so therefore they weren't considered a fiduciary. But now that goes away, and so that's a huge change from the current environment and the industry out there for investment advisors, investment brokers, custodians, and trustees. And so this will cover a number of retirement plans, mainly those that are subject to ERISA Title I, and being the defined contribution plans, your 401As, 401Ks, 403Bs, your defined benefit plans for those few that are still out there, and even IRAs. Just one quick example of what it wouldn't cover is something like a 529 plan. So while this change does impact the industry providers a little bit more than directly your plan requirements, what you all should anticipate is definitely an increased level of disclosure, especially around the fees and commissions, and potentially additional fees related to this investment advice, because really they'll be trying to compensate for the increased risk and liability that they'll be taking on now being a fiduciary under this plan for their clients, whereas they haven't been in the past.
So, Jennifer, can I just jump in real quickly?
Please
with
do.
a quick comment? The other thing to keep in mind as well is, part of what they're trying to accomplish here, a lot of plans are set up, and you're set up on a platform, and you're given a certain offering of funds, and the funds are within certain share classes. And what they're doing is there's a revenue share there. So when they say they want fiduciaries to act in the best interest, you would think it would go without saying that they're going to act in the best interest of their clients and advise them appropriately. But there has historically been some bias there, in that if your plan is on a platform that has certain funds, and those funds have a revenue share where the investment broker is getting some fees from those funds, because that's how they're making their commissions and they're not charging the plan directly, then it is, which is perfectly legal, then there may tend to be a bias there. They may not be saying to you, okay, we want to move you from this fund offering over to this platform. So we're probably going to see a shift there. And of course, we had the fee disclosure rules that came out a few years ago, which helped with that as well. So really, there's more of a push for the plan providers just to be more transparent in terms of what they're offering and what they are getting paid for it, what they're charging.
Yep, absolutely. Great. So we do have a monthly webinar series that, please feel free to tune in. Our next one will be May 24th, and it will be the road to audit readiness and some best practices for that year-end closing of your books. But we did get several questions while we were presenting, so maybe Jackie, I can read through some of the questions and we can try and answer these. And if we don't get to all of the questions, we will get to them after the fact and reach out to you to make sure you all get an appropriate answer. So one of the first questions is with regard to nonprofit organizations. Do you anticipate more scrutiny on the board of directors roles as it relates to employee benefit plans? And I can take that one. I think with the changes, especially on the 5,500, it's exactly what one of those changes will try and aim to get at is to, yes, there will be more scrutiny, and that ultimately this is now a best practice that the board or a committee takes an active interest in the plan and that they are reviewing the plan and the funds and the investments. And so that right now is a best practice. It's not a requirement by any means, but I believe that will be incorporated more by asking specifically about that concept on the new 5,500.
Okay, so Jennifer, I do see a couple of questions here asking about future anticipated changes due to action by Congress, the change in administration, who will opt for IRAs due to any changes in the government standards and employment. Right now, we don't have an answer for that. It's too soon to tell what, if any, changes are coming down. I will tell you that it took them, they're very slow. It took them a very long time to come up with this new fiduciary rule. It was proposed several years ago, and then it was tabled for a while due to reactions from, certain groups. And they tabled it, I believe, for almost 5 years until they resurrected it and addressed it again and finally came out with that change. So it's really difficult to say what changes will be coming because, they may come up with something and then table it, and it may collect dust for a while and come back, or they may just do away with it altogether. So those questions are a little bit harder to answer right now.
Yeah, I mean, absolutely, Jackie. It's, everything with the change in administration, everything is still kind of uncertain, and nothing has been finally decided at this point. So, as we hear, we'll certainly make you all aware of what those anticipated changes are through our ongoing education. All right, so I see another one that since modernization seems to be a motivator, will electronic filings be the norm? And if so, does this include organizations' ability to amend submission without penalties? So as far as the electronic filings, I know the answer to that is yes, that they are moving to, again, the more data fields and being able to upload that so that they can take that data and mine it for additional analysis. And so with that, it will be it will aim to completely be paperless and with the electronic submissions. As far as the submission without penalties, I'm not exactly sure on that, so we'll have to see how that plays out over the next several years.
Yeah, I would not foresee them dropping penalties for submission, lack of submission or amending after submission, but you never know. But you just do not know. One of the other, I'll take another question.
Yep.
Someone asked, we are part of a group plan, several organizations and a federation that share a plan. I believe we would fall into audit needs. Would the standards apply only to the administrator or all organizations who participate? That's a good question, and that's the type of answer that we would actually need to see the plan document. We addressed this issue recently with a client. Again, unfortunately, I'd love to give you a yes/no answer, but it's kind of gray. It appears to me that this is a multiple employer situation. There's also a multi-employer, and believe it or not, they're slightly different. And it depends on how the plan document is written and who they're considering to be the sponsor of the plan and how the different plans are set up. So, again, you know, we would need, I mean, if you want to contact one of us after the webinar, and maybe we can help you out with that question, we would just need a little bit more information for that. So unfortunately, the answer is maybe, but we would need more information.
So there's a question about what are some common examples of those net asset value investments. So the most common ones that we see as far as the retirement plan are your pooled separate accounts or your common collective trusts. Those are pretty common investment vehicles that are offered within retirement plans. And the most common one as far as the financial statement side will be your limited partnerships. So if you have investments in limited partnerships, they are most often calculating the value of that investment on a net asset basis. All right. Let's see. Any other? Do you see any other questions, Jackie? I don't think we have any others on our end. Okay. Well, no other questions. Thank you all. Go ahead.
Sorry,
Jackie.
Jennifer.
No problem.
I was on mute. I did see one other question pop in that I would like to address here. So someone asked, what happens if after filing our 5500 we discovered that we should have had an audit? So we actually see that a lot, and it's not the end of the world. We do, the IRS and the DOL offer correction plans. They have the VCP, the Voluntary Correction Program, which makes it much easier to go in and correct any mistakes, if you will, and file a corrected 5500 with an audit. When we do see situations like that, we do encourage our clients to address the situation as soon as possible. Have the audit, better late than never, do a corrected filing. And when you go under the plan, there's usually a reduction in any penalties that they may assess. So the idea being that they don't want to penalize employers and plan sponsors. They want to protect the participants, they want to protect the assets of the plans, and they want to help and enable the employers in doing so. So they're not trying to have a gotcha, you know, you're in trouble. That's why they set up these voluntary correction programs, which are fairly easy to follow. If you go on the EBSA website, the Employee Benefit and Security Administration website, because they are trying to help. They want you to know that the resources are there and that they're available to help, and they want employers to be forthcoming in admitting they made a mistake and asking for help so that they can make sure all of the plans do stay in compliance. So I think that might be it.
I think so.
Wonderful. Well, thank you everyone for participating. And again, feel free to contact us offline with other questions if we can help. You know, we're certainly here available to help. And again, the slides are available for download if you would like to download those. And again, this webinar was recorded. If anyone wants to review it again, we do have it on recording. And we have other webinars coming up. So another one coming up as part of our webinar series on May 24th, if you can join us again. That'll be a good one about audit readiness best practices. So thank you very much, everyone.
Yep, thanks, everyone.
Thank you, Jennifer.
Thanks, Jackie. All right, bye.
Bye.